Hey everybody, it's Mike over at Taxes and Bricks. Well, welcome to episode 36. It's time for another Friday mailbag. Ooh, exciting. All right, but first, if you like this kind of content, you want to see more of this content, don't forget to like, subscribe, turn notifications on, so every time I throw up a video, your phone will tell you, annoyingly so. Also share our content with your friends. I think last check we're up to almost 80 subscribers, which is kind of insane. It doesn't mean anybody's actually watching these videos, but hey, whatever. People are subscribing. People like me. Yay. Anyway, and also because this is going to be tax related, I will go ahead and throw up a little disclaimer here to pay the lawyers, and we'll be right back.
This video is rated TAX and contains occasional ramblings, mild attempts at humor, self-deprecation, irreverence, brief numerical examples, and adult tax and accounting advice that may not be suitable for all taxpayers. Viewer discretion is advised. Before following any of the advice in this or any of our videos, you should always consult with a tax professional. Thank you.
All right, welcome back. So, got 4 questions today, actually, and they're all kind of small business, self-employment type questions. The first question came in earlier this week. It was from a client who is a self-employed individual, a consultant, and they asked me about the tax benefits of forming an LLC. And my response was kind of a shocking one. There are no tax benefits to forming a single member LLC. What is a single member LLC? Well, that's generally what people end up forming. Is they're a small business owner, or they're, self-employed, they're a real estate agent, or they're like a, general business consultant, or maybe they're a photographer or something. And they want to put sort of a professional face on their business, so they want to start LLC, like Mary Jones Enterprises LLC or something, instead of running around just as Mary Jones. And there's this giant misconception out there that magically you throw the word LLC or the letters LLC behind your business name and boom, your taxes just disappear like magic. No. LLC, or limited liability company, is a legal entity. It is not a tax entity. Yes, the IRS does get involved insofar as it will go ahead and issue you a tax ID number and allow and recognize your LLC. But after that, the IRS classifies LLCs, single member LLCs that is, as disregarded entities. A disregarded entity is exactly what it sounds like. It's an entity that the government just doesn't regard. So single member LLCs, not tax entities. Therefore, anything that you could do as a sole proprietor or a single, single individual running around there making money, you can do it as an LLC and vice versa, okay? LLCs that have multiple members, so a multi-member LLC, or what's known as a partnership, that's a little different story. There are some tax benefits to having a partnership. There are certain tax forms that you've got to file that are different than your personal returns, but maybe another conversation for another day. But in general, just a single person out there, running the show, your own business, 100% owner, and you're going to be the only member in the LLC, it's not a tax thing. So bottom line, don't call your accountant, call your lawyer. All right. Next question was actually sort of related to this. It came in actually same day. It was somebody who was starting a small business. They weren't so concerned about the concept of an LLC. They just were kind of confused about what's tax deductible and what's not tax deductible. And so my response to them was this. I have a list, and I provide that list to people of sort of the generally accepted small business type deductions, things like, office supplies and buying a printer and buying a laptop and, taking people out for meals or, whatever, doing some business travel, that kind of stuff, the typical things. But when we start to get into the specifics of a deduction, I apply 2 tests, and these are not tests that I created. These are tests that are in the law. The first test, and by the way, a deduction, in order to be a deduction for a small business owner, has to pass both of these tests. It has to be both ordinary and it has to be necessary. So that first test, ordinary, what does it mean? Well, ordinary basically means that any business would have this kind of a deduction. So, like a printer, any business would have a printer, any business would have a laptop, any business would have like a telephone line, or, any business would, rent an office or something like that, or, pay for internet. Like, that's a pretty common ordinary deduction. Or ordinary can also mean that maybe not every business or any business would have it, but a business in your specific industry. So, easy example, like a doctor is going to get a doctor or a medical license, but like, I don't know, a self-employed, trash collector isn't going to have a medical license. I mean, maybe they would because they're, going to help deliver your baby while they pick up the trash. But I mean, in all reality, no, like a trash collector's not going to have a medical license. But also, too, a doctor wouldn't necessarily, have to purchase a trash truck or something. So just because something isn't widespread for every single business doesn't mean it's not ordinary. It can be ordinary if it applies to your specific industry. Okay? The next test is necessary. What does necessary mean? Well, necessary means that basically, in order to either make your money or run your business, you must incur the cost. Okay? So, good example would be something like utilities on an office. Let's say you rent an office somewhere, and utilities, they're pretty ordinary, and if you don't pay them, they shut your lights off, and then you have to see your clients in the dark, which would be problematic if you were a doctor. Maybe not so much if you were a sleep doctor, but if you're like a doctor that has to do, heart surgery, maybe you kind of want a little electricity kicking around your place. Anyway, all right, so necessary. You gotta have it. Necessary also can apply somewhat to the actual cost of the item. So it may be necessary in terms of like you have to have it to run your business, but it can also apply to the actual amount of money you spend on something. So let's give an example. So let's say you own a desk. You buy a desk for your business. That's pretty ordinary, right? I mean, most people have desks or, whatever. And so you go out though, and instead of buying just a normal desk at like Staples or, IKEA or something like that, you go to an auction and you spend $150,000 on the desk that, I don't know, Mario Puzo wrote The Godfather at. No. The government's never going to buy that, because you could have gone out and you could have bought a desk at IKEA for like $100, or you could have even spent maybe $500 or $1,000, and that would have been more reasonable. And so therefore they're going to say maybe the desk was ordinary and the desk concept is necessary, but the expenditure of $150,000 on Mario Puzo's Godfather desk probably wasn't necessary. So you wouldn't necessarily pass that test. So ordinary, necessary, you pass both tests and you're golden for your expenses. I went a little further with this discussion and kind of harkened back to one of my first video back in early January, which was, I said, look, there's this there's this sort of myth out there that like, as long as you're paying for something with a credit card or a bank card or something like that, you don't need to keep receipts. That is total garbage. I don't know who started that rumor. You have to keep receipts. You don't have to keep the paper. I mean, I do, but that's just because I'm like an idiot and a total nerd, and I'm also lazy and don't feel like scanning them. But I don't keep, like scans of everything. You can do that if you want, but I keep my receipts, and you have to keep them because the receipt is going to detail out what you bought. And you're thinking to yourself, well, but like the credit card statement shows that like I went to Staples and I spent $100. Yeah, but what did you buy at Staples? Because I went into a Staples not long ago, and you can buy an awful lot of crap in there that's got nothing to do with business. Okay? I mean, they've got, crayons and, back to school supplies for kids, and you can buy a backpack. I mean, they even sell clothes and shoes and like food in there now. I mean, they sell all sorts of garbage in there that has nothing to do with business, okay? Also, too, going with the whole ordinary and necessary thing, I mean, if you buy something and your receipt shows that you bought it, but it's not ordinary or necessary, that's going to be kind of problematic. So, I mean, I guess in that sense, you probably don't want the receipt, because then you may be able to talk your way into the deduction. But ultimately, if you have an ordinary and necessary expense, you got to be able to show the government what it was, okay? So, all right. The next two questions came in actually from the same client. the first question was about writing off an automobile as a small business owner and what some of the requirements were. And I had said, well, listen, no matter what you do with a car, okay, you have to track your miles, okay? The reason you have to track your miles is because regardless of whether or not you use what's known as the standard mileage rate deduction, which is basically how many miles you drove for business times a government set cent per mile, and that's your deduction, or you're going to use the actual expenses on your car. So, gas and oil and filter changes and tires and, interest on your car loan or lease payments or whatever, okay? You got to be able to point to a percentage. And without having the mileage, which is basically the only measure of the usage of an automobile, there's no real way that we can figure out what percent of your car you're using. You can't just say, I use my car 100% for business. It really doesn't work. I mean, there are some vehicles out there where the government's going to buy 100%. But honestly, if you own one car, at some point you swung into a Starbucks and bought yourself a latte. It's just the way it is, okay? The government's never going to buy 100%. At some point you went on a vacation and you drove to the beach, and that wasn't business. At some point you went food shopping for yourself, not business related. So to say a car's 100% and just say it's 100% and that's it, it's never going to fly. So you got to keep mileage logs. Here's the deal. There's an app for that. There's 1,000 apps for that. But the one I use is called Mile IQ. I do not get any type of kickbacks from them or anything like that. I like to give people good advice and good resources, and I don't care if I get paid on it or not. So Mile IQ, it's an app I've used for like 100 years, ever since it came out, before it was owned by like Intuit or Microsoft or whoever the hell owns it now. It tracks everything, and I kind of like call it Tinder for car mileage logs. You swipe left for personal and right for business. I don't know if that's like the good thing on Tinder, like left for, good and right for bad. I don't know. I've never used Tinder before because, like, hey, I've been married for 100 years, but whatever. But anyway, you swipe left for personal and right for business. The good thing about it is it tracks everything. It knows when you're moving. It knows the things. So, like, right now, it's on in the background of my phone. It's tracking this trip that I'm taking, okay? Which, by the way, I'm writing off because, hey, I'm talking taxes. Woo! Okay. The next question about the car was whether or not you can buy an exotic car and get some kind of a boost or a tax benefit from it. So I inquired because as a car guy, I had to wonder, like, when somebody says exotic, I'm thinking Lambo, I'm thinking Ferrari, I'm thinking like Aston Martin, Maserati, McLaren, I'm thinking, you name it, okay? Turned out the client wasn't buying something that I would classify as exotic, but I guess they classified it as exotic. The sad part is that even though the car I wouldn't classify as exotic, it was still $160,000. And it kind of got me thinking that cars are just way too friggin' expensive these days for four wheels and a motor, but whatever. Anyway. But let's stick with the fact that, like, let's say my client was going to buy a Lambo, like a Lamborghini or a Ferrari, and they were going to drive it back and forth for their, job, and they were going to, not job, but their self-employed business, and they were going to, utilize it to run errands. I mean, I don't know what kind of, office supplies you can stick in the, front boot of a Lamborghini, but whatever, okay? Maybe you put a lot of crap on the passenger seat. Anyway, they thought that since the car was going to be extraordinarily expensive, that they would get like this huge tax break for buying this, very expensive car. In this client's case, $160,000. And what I was thinking was probably, in my head, I was thinking like $400,000, $500,000, $600,000, $1 million, something like that. Because listen, not for nothing, but this client could probably afford $1 million car, but that's beside the point. Anyway, the answer is no. Whether you buy a Lamborghini or a Camry, okay, whether you buy a Ferrari or a Fiat, and I don't care what it is you're buying, okay, there's a cap on the cost of a vehicle before basically depreciation is essentially the same. And I think at last check, and I don't look at these things because they tend to change from year to year, but it was like $36,000 or $40,000 was what's considered the luxury auto limit. And that means that the depreciation on a $40,000 car in the first year is going to be basically the same as a depreciation on a $160,000, Escalade, or a, $190,000 Porsche, or a $600,000, Lamborghini or something like that. And if you think about it, that kind of makes sense in the sense that, I don't know about you, I have no problems with, and I would never begrudge anybody the right and privilege to purchase a ridiculously expensive supercar. But I'm not so sure that with my tax dollars, I really want to subsidize that. I'd have to think about that. Let me think about it. Yeah, no. You buy your Lamborghini, congratulations if you can afford it, but really my tax dollars shouldn't go to pay for it. And that's not a commentary on like one way or the other. I just think like, honestly, I think that just makes sense. And we shouldn't be giving people who can afford a Lamborghini a gajillion-dollar depreciation deduction, which comes out of the taxpayers' pockets. And I think the government thinks that, and I think most people agree with that. And so, that's the deal with it, is that whether you buy a $600,000 car or a $60,000 car, you're probably going to get the same depreciation the first year. Now, that only goes for automobiles that weigh under a certain amount, okay? So if you have an SUV or a truck that weighs more than 6,000 pounds, and that's the gross loaded vehicle weight, there are typically, and have been since basically 2001, 2002, significant bonus depreciation that exists for those kinds of vehicles over and above any sort of standard small, kind of underweight SUV or underweight pickup truck or underweight vehicle or underweight car, underweight being under 6,000 pounds gross loaded vehicle weight, okay? I went a little further with this question, though, with the client, and I said, listen, because what they were talking about was they were actually talking about buying a very large, expensive SUV. They just considered it an exotic. I guess it's exotic, but I don't know, whatever. I guess I'm a snob. I don't think it's that exotic, but whatever. Anyway, I went a little further, and I said, look, I said, how long are you going to keep this car? And they said, well, probably a couple of years, and then get rid of it. And I said, well, you're going to be careful, because right now, people are kind of buying automobiles and they're used and then they're selling them and they're not really losing a lot of money on them. I said, not like in the olden days when you bought a car for, $80,000 and then you kept it for 2 years and you had to pay somebody to take it because they basically used cars were worthless. Now it's kind of not the same. And I just reminded them that whatever depreciation you take on a vehicle, okay, in this case for this large SUV, it was going to be pretty substantial, okay? But no more substantial than, any other SUV, so, whatever. But I said, look, just remember that gets recaptured. It gets added back when you dispose of the vehicle, whether you trade it in or whether you sell it. So I just warned them, depreciation taken on a business use vehicle does come back as recaptured or income to your returns for that particular year. So anyway, those are my 4 questions for this week. Really kind of, the 4 questions, Passover is coming up too. Wow, great. Just wove a little religion in there for you. All right, so those were my 4 tax-related questions for this particular mailbag. Thanks for joining me. I hope you enjoyed the ride. Let's see. Starting Monday, I think we're wrapping up with state withholding. Be back Wednesday for, I think, some more Lego architecture. Do a Friday mailbag, and then we'll be back for another week of fun and exciting Lego and tax content. Don't forget to like, subscribe, turn notifications on, share our content with your friends. And thanks for watching. Have a great day.